Good debt isn't about how much you owe. It's about whether the money you borrowed makes you richer or poorer. Bad debt buys things that lose value. Good debt buys things that pay you back. The rule most rich people follow: never borrow more than the asset can earn back. Take real estate. Someone borrows 80% to buy a rental property, the tenant's rent pays the loan, and in 10 years they own an asset worth double what they paid, using mostly the bank's money. That's leverage. And by the end of this video, I'll walk you through a real example of someone who did this. The exact mistake that almost cost them everything. The one rule that saved them, and the question banks hope you never ask. But first, let me show you why almost everyone gets this wrong. Most people believe one of two lies about debt. The first lie: all debt is bad, full stop, never borrow money, pay for everything in cash. Sounds safe, right? But this is what keeps people broke. Wealthy people and business owners don't follow this rule. They use loans as financial tools. They use leverage to grow money faster than someone saving cash ever could. The second lie is the opposite. Debt makes you rich. So just borrow as much as you want and watch the money flow in. This one sounds appealing, and it's actually more dangerous because it feels like freedom until the bill comes due. The truth? It's both. And neither. It depends entirely on one thing. And I'm about to give you the exact formula banks use to decide if you're safe to lend to, and it's simpler than you think. Here's how you actually know if debt is safe. It's called the 28-36 rule, and it's the line between building wealth and financial ruin. The rule has two numbers. Number 1, 28%. Your housing costs, your mortgage, rent, property taxes, insurance should never be more than 28% of your gross monthly income. That's your housing limit. Number 2, 36%. This is the big one. Your total debt payments, everything combined, housing plus car loans, student loans, credit cards, all of it, should never exceed 36% of your gross monthly income. So if you make $5,000 a month gross, your total debt can't be more than $1,800 a month. Cross that line, and banks actually view you as risky. Go above 40%, and they'll deny your credit entirely because your cash flow is too eaten up. Now here's what separates good debt from bad debt: what you're borrowing for. Good debt buys things that either grow in value or make money. A mortgage for a rental property. The tenant pays your loan while the property goes up in value. A business loan, you use it to make products or services that earn you way more than the loan costs. A student loan for a degree that leads to a higher salary. Bad debt buys things that lose value or make nothing. A car loan for a car you drive every day. It depreciates the second you drive it off the lot. Credit cards for vacations and clothes. Money you borrowed that doesn't work for you. But here's the thing nobody tells you. Even good debt can ruin you if you don't ask the right question before you borrow. And I'm about to show you exactly what happens when someone asks this question too late. This is the story that changed everything. There's a guy named Dave Ramsey. In his 20s, he built a real estate portfolio worth over $4 million using bank loans. Smart guy. Good debt. Everything was working. But he made one mistake. He borrowed on short-term notes, 90-day loans from his local bank that he assumed would just keep rolling over forever. As long as the bank kept renewing them, he was fine. He didn't think it through. His money was all locked up in properties, not in cash. He was living paycheck to paycheck from rent income, assuming the system would never break. Then in 1988, a larger bank bought his local bank. New management looked at his file and said, "This guy is too risky." They called his loan due, $1.2 million in 90 days. He couldn't pay it. He didn't have the cash. His properties were worth money, but he couldn't sell them fast enough. So what happened? He went into a financial death spiral. Bankruptcy at age 28. 3 years of stress, losing everything, having to rebuild from nothing. Here's the part that matters for you. This wasn't bad luck. This was the mistake. The mistake. He used good debt, but he didn't keep cash reserves. He had all his money tied up in assets. When the system broke, he had no safety net. The rule that saved him, and I mean this literally changed the course of his entire life, was the 6-month liquid reserve rule. Never borrow money to buy an income-producing asset unless you have at least 6 months of total debt payment sitting in a separate savings account that you never touch. 6 months of your mortgage payments, maintenance costs, everything, in liquid cash. Just sitting there. Why? Because life happens. Tenants stop paying. Your job ends. The market crashes. The bank changes management. If you have 6 months of payments sitting there, you survive. You don't panic. You don't lose everything. This one rule, this single decision to keep a cash buffer, is what separates rich people who use debt from broke people buried in it. But there's something else banks don't want you to know about debt. Something that changes how you should think about every loan you ever take. Banks have a lot of power, and they rely on you not understanding it. First, your debt can be collected across different institutions. Banks have systems that link all your accounts. If you miss a payment on a loan at one bank, they can reach into your savings account at another bank and pull the money directly. You don't get a choice. It's automatic. Second, there are credit registry systems. One default in one place, and every bank in the formal system knows about it instantly. You get blacklisted everywhere. Third, and this is the big one, your terms are negotiable. Interest rates, fees, repayment schedules. Banks want you to think it's all fixed. Take it or leave it. But it's not. It's negotiable. Banks prefer you think you have no power because that lets them keep their margins high. And finally, minimum payments are a trap. Paying only the minimum on credit card debt, you're barely covering the interest. The principal never shrinks. You're locked in a cycle designed to keep you paying forever. But here's the insider question, the one banks hope you never ask yourself before borrowing. Can I truly afford to repay this loan every single month without harming my basic needs? And what's the total cost going to be? That's it. That's the question. Not, can I afford the down payment? Not, can I afford the first year? Can I afford every payment, every month for the entire loan term while still eating, paying rent, and surviving? If you can't answer yes to that question, the debt isn't good. It's a trap, no matter how good it sounds on paper. So here's what I want you to do right now, today, before you take on any new debt. Pull out a piece of paper or open a notes app. Write down this number. Calculate 36% of your gross monthly income. That's your total debt ceiling. If you make $5,000 a month, that number is $1,800. Now write down every debt payment you have right now. Mortgage, car, student loans, credit cards, everything. Add them up. Are you under 36%? You're safe. You have room to use debt as a tool. Are you over 36%? You're in danger. Don't borrow another dollar until you pay some of this down. That's the math. That's the safety line. Keep it somewhere you can see it, because it's the difference between debt that builds wealth and debt that destroys it. Do that today, not next week, today. Remember at the start I promised to show you the question banks hope you never ask? You just learned it. It's, can I afford this every month without harming my basic needs? Use it before every loan, before every credit card, before every investment. And if you want to learn more money moves like this, the ones they don't teach you in school, the ones that actually separate rich from broke, hit subscribe. I break these down every single week. Thanks for watching.